From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, February 4th. It's Jobs Day. You're listening to the Macrocast. This is Tony Fratto with Hamilton Place Strategies, along with Matt McDonald at Hamilton Place Strategies, John Fagan and Brendan Walsh from Markets Policy Partners with us. Guys, this was a blowout jobs report today. Just huge numbers, huge revisions, lots of juicy news in there. Why don't we go to Matt to give us sort of like the tail of the tape a little bit, and then we can dive into it a little bit.
Yeah, there's plenty to chat about. This was a win-win for the Macrocast, because if the jobs number wasn't good, there was going to be plenty to talk about, and if the job number is good, there's been plenty to talk about, but in different ways. The report was 467,000 new jobs. The unemployment rate ticked up a smidge to 4.0%. Big revisions upward of around 700,000 in the prior couple of months. The labor force participation rate ticked up too, which is good. I think it's important to set the context for this. Is that I think the forecasts for this were around 125,000 new jobs, but there were a lot of whisper numbers that this could be negative. That because of people being out sick for Omicron or a host of reasons, that there was kind of a view that it could be a negative number. It obviously was not. So all like good stuff. Under the hood, that it's interesting. There is actually a fairly significant number of people who reported jobs being impacted by coronavirus. It was on the order of 6 million, which is up from 3 million the prior month, and pretty notable. But overall, a really strong report. My sense was that if the numbers were negative, people were ready to shrug it off as kind of an afterthought. But with a report this strong, indicating kind of the direction of the economy and a host of other things, it seems to kind of solidify people's view that we're entering a rate hike cycle, and that's any kind of speculation around timing of that sort of stuff or amount has kind of been put to bed by this pretty strong jobs report to kick off the year.
There's a lot of sort of some irony, Matt, in the in the expectations. Not just this month, but last month also, right? Where the number last month was, everyone was castigating the forecasters for expecting a big number. And it was a really, really disappointing number. And so they were off for overshooting on expectations. This month, was just wild range. Like you said, the private sector expectations were 100 plus 125,000 jobs. I think it was kind of a medium, but not because they were all clustered around 125. They were as high as plus 400,000 to that negative, a couple 100,000. So it was a really wide range in expectations. And some of that was because this is a dynamic moment in the economy. Like Omicron is certainly an issue, trying to guess at what employers were doing. The administration was out whispering, this like theory, which it's somewhat reflected in the numbers. I think you said could people affected by Omicron. Yeah. But this theory that, people were not going to be at work, but they were out of sick days. And so they were,
the administration was not the only one whispering that, though. There were definitely, like, I saw forecasts from the banks that were saying there's going to be negative numbers. That I think that came from the administration. To your point, I do think that, and we've talked about this for a while, but I think like the pandemic and post-pandemic has been very difficult for forecasting for the official sources that are gathering the data. I think it's been a very difficult exercise to model all this out. It's very unpredictable. And it's one of these exercises where you get the headline and it's like, okay, cool. Like, bottom of the ninth, game's over. And then it's like a month later, it's like, oh, actually we have 3 extra innings. We're going to revise the
and that's
score.
A good point. We criticized everybody last month in December for being too optimistic. Well, they actually were right. But the job isn't you're supposed to predict what the first print is. So there's levels of, or there's second derivative and third derivative.
That's exactly right, Brendan. That's sort of my point. Because like if you throw in the revisions, and actually private sector forecasters were actually closer to correct last month on actual job creation.
Yeah,
they just were not very good at predicting
jobs in December, where we thought we had 100.
Yeah, they just
maybe we will get to the point where the people. Maybe we'll get to the point where the people prognosticating they're gonna come on TV in the morning and they're gonna say, "What do you think the number is?" And they're gonna say, "Well, I think we're gonna get 100,000 jobs, but I think it'll be revised up to 300,000 next month, and then revised back down to 250 the month after that." That's what we need for the forecast.
Exactly. That would be that would be like that's advanced level forecasting if you could do that. But look, I guess bottom line, all the way around, this is a great day. This is a great number.
No, and you've been saying it for a long time. Yeah. The U.S. economy is a lot stronger than DC and Wall Street want to give it credit for.
I want to read you something. Here's what Jason Furman tweeted this today, and see if you guys agree with this. He said, January 2022 will be remembered as the month the virus ceased to be boss. It wreaked havoc and death at a terrible scale, but the economy no longer cares. People returned to the workforce. The economy added jobs. Wages rose. You would barely know it happened from the economic data.
Yeah.
He's right? I mean,
no. So I just kind of indicative of what January is like. I drove from DC to Massachusetts in early January when the wave was really hitting, and I stopped on the Jersey Turnpike a few times to try to get lunch. And of the 5 fast food restaurants, each place only one was open because they had staff shortages because the employees had Omicron, so they couldn't come to work. On my way back, but the bigger point is, those rest stops were jammed with people. So while the fast food had a week of not being able to staff it, it didn't affect activity amongst the broader economy. People are out doing things.
And it seems
just couldn't get your Chick-fil-A.
And it seems that's a trend. That's a trend that we should look forward to, barring some other
because in DC now we were one of the first hit. And we are now the lowest rates in America. We're below 100, cases a day. It really does hit you hard, and then it falls off a cliff. So knock on wood, February and March could be back to normal. I have a friend that's in commercial real estate, and he said that this week was really a turning point where he's getting a huge amount of inbound calls from developers saying we've got to get going, or else we're going to miss our opportunity.
John, what was market reaction?
Well, typically, you see this good news is bad news motif. I'm sure the general public gets baffled when they see the flickering headlines of, equity futures sink on stellar jobs report. But this is a very well-worn motif in the post-global financial crisis, central bank dominated era when, better growth numbers can mean faster central bank tightening, and that's certainly what the markets are predicting here. Equities were off a ton yesterday, so they're up a little bit today. But that knee-jerk reaction is kind of indicative of the broader trends that we've seen, which is all of this optimism, which is delightful and encouraging, and these numbers are terrific. You guys should all be wading into the Russell. The small caps stocks. You should be trying to get into Treasury yield curve steepeners and other trades, because Wall Street has been flashing growth concerns, and really basically the message from the markets has been, the Fed is fighting perhaps last year's battle with inflation, or that the cure,
or that they're fighting the correct battle, and inflation really is going to get out of control.
Well, yeah, it's just, if you look for inflation fears in financial markets, it's really hard to see. If you're looking at tips break evens,
I'm talking more about the equity markets than the bond markets.
Break evens, equity markets. Equity markets are flashing growth concerns. We've seen a lot of dismal performance from the small and mid caps and the Russell and that kind of thing. This is it's a really challenging time for financial markets, and this is. Although this is fantastic data. If you had to pick one data that is the most backward looking, it's the jobs
employment report. Yeah,
it is rear view mirror as you can get in the entire in the entire economic complex. And market participants are
because also it's not all of January; it's the middle week of January.
And market participants are just very uncertain about the environment right now, because the big headwinds that are showing up for growth. Clearly, we've got a big fiscal drag coming up. All these programs. That's just. I mean, it's like it is occurring in a major way. We've got. We'll talk about this more. We've got oil prices which are looking far less demand driven and much more supply and sort of geostrategic driven. The risk asset complex has corrected a lot this year. Oil prices have not joined it. They've decoupled to the upside, and we're at 7+ year highs and marching higher as the Russian army is marching as well. It's a very challenging situation. And you're also seeing, global growth. Germany is in a technical recession. China is really weak, and they're still
trying to do zero COVID policy, which is anti-growth.
And we have seen some muddiness in retail sales. We've seen muddiness we get next week the University of Michigan's fantastic consumer survey data that comes out next week. That's been really kind of sorry over the last few months. So this may resolve in a very pleasant way in which the virus isn't boss, and that would be great. But it would be a terrible irony if, just as the virus isn't boss, the headwinds that have sort of snuck up on the market and the economy are rising to give us something of a cyclical slowdown.
It's worth pointing out in the jobs report that wages continue to move up at a pretty good clip, which is on the one hand nice, and on the other hand is a piece that people have been looking to see how baked in or like self-reinforcing the inflation dynamic becomes, and is yet another point for the tightening cycle that we're entering into.
Right. So just for all employees, we were up about 5.7% on a yearly basis. But when you look at leisure and hospitality, which January was very encouraging, we added 151,000 jobs. That's where people have really not wanted to go back to work. But the yearly wage gains for them is almost 16%. I was listening to the earnings call of Waste Management, and the CEO was saying, we're doing quite well, but no one really wants to pick up trash, so we've got to pay people a decent amount of money to do it, and we can find them at the right wages, but the dynamic has definitely changed.
I also, it's interesting. I think that I'm kind of a fan of the musical chairs cycle of the labor market, where the weight of the power shifts a little bit to the worker away from the firm, because I think that it can result in situations where people either get a better job or more importantly get a better fit of a job. I think that the whole Great Resignation thing is overwrought and overhyped. I don't think people are not working again. I do think that there's a shift of this has been a long couple years. Everybody's trying to hire. Is this really what I want to be doing? And over some longer period of time, you want people in jobs that they want to be in. They will be happier, more productive, and the firms will do better. They're going to be 100%. They're going to be crappy firms that aren't great jobs or aren't great places to work or whatever, and they will suffer as a result of this. And that's part of the cycle. But I do think that you get these cycles of competition for workers is a really good thing that can unlock a lot of opportunities, both for individuals and for the companies they work.
I think
I've definitely noticed lately at the office, you and Tony, berating the employees much less.
It's absolutely true. I mean, I like this. The sorting is really, really important for long-term productivity gains, and but it's not a new lesson, right? It's that's almost an old lesson, right? The idea that people staying in their jobs for you get hired and you stay there for 30 years. This is a Japanese story, staying in a Japanese company for all of your career. It sounds really nice and safe and secure, and is just absolutely horrible for productivity. because everything changes. You change, the job changes, the kinds of things that that your desires change, but you stay locked in because you kind of have some golden handcuffs because you've achieved some certain things. So I think Matt's absolutely right. It's like it's a hidden boost for productivity for people to be in doing the kinds of things that they really, really enjoy doing, and they jump out of bed in the morning doing, just like all of us do.
No, but we've, in terms of new small business filings, we're at records in the last 6 months. So, and also those ones, the BLS doesn't necessarily capture quite well in real time. So, we could have a lot of, we might have added even more jobs than we thought. So we lost 22 million jobs in the pandemic, and we've, from BLS statistics, added 87% of them back. But you also have a lot of people doing, side gigs and small businesses that, that's kind of hard to capture in real time.
Can we turn to the Fed? Matt alluded to that it's like we're in a rate a tightening cycle, and that it gets true. And but like, are we pricing in anything more this morning? I mean, is more likely? What do you guys think about more likelihood of a 50%?
The odds did go up on the back of this number. They were about 20-25, and we're up to, I believe, about 32% now. I personally don't think that they would. Also, for the first hike, you would really, and we have very volatile markets. You don't need to rush to 50, especially as you're shrinking the size of your balance sheet. But the market is starting to price in both the Fed. So before we were hiking because of inflation. Now we might be hiking for a combination of strong growth and inflation.
Yeah, the Fed commentary this week was a little bit more incrementally more balanced, right? Last week's commentary that Fed Chair Powell delivered after the January meeting was very skewed toward inflation. Obviously, the questions from the press were focused on that. But even his commentary was really clearly setting the risk skew all on the, tighter than we already are predicting. This week showed a little bit of the other side, a little bit more balance. Fed speakers coming out and nodding to uncertainties about growth, acknowledging that they want to conduct a hiking cycle that isn't disruptive to the markets and isn't self-defeating. And that's the kind of commentary that they should stick with, in my opinion. This is a very uncertain period of time. Having tunnel vision on inflation can risk basically the sort of reflation and reverse dynamic that it tends to create in financial markets, can swamp your actual policy approach. And so I think that balance, I agree with Brendan. I think it's a low likelihood that they come roaring out of the gates with 50 basis points in March. And I think that they have I'm still, lower than, I'm taking the under on 5+ rate hikes this year. So
I agree with you guys, and maybe I'm just hanging out with you too much or something, but like, I don't understand why. It feels to me like, if you look at the broader history of kind of Fed commentary on where we are in both the pandemic and in the jobs market, focus on full employment, focus on reaching into the last parts of the economy to reach, with an acknowledgement of like the inflation and the fact that they need to move on this stuff. All the signals to me are kind of a slow and steady, like, correction in the other direction. And where is but I hear plenty of commentary that it's like 7 rate hikes or 50 basis points to start, or all this sort of stuff. And I don't see why that would be the
I think it really has to do with your outlook on inflation. A lot of, especially Wall Street pundits and participation are very negative. They think that we're in a hyperinflation environment. That's where I differ. I think we've probably seen the worst of it. A great data point came out yesterday. Used car prices went down for the first time basically in the pandemic in January. That's an amazing sign. Yeah. They were up 60%. used for the entire history of the world. As soon as you buy a car, it depreciates the minute you drive it off the lot. We had a shortage of cars. We're working our way through it. And I think a strong back-to-back strong jobs numbers are a great sign that we're working our way through the supply chain issues, and that the things that have really driven inflation up to 6-7% are behind us, and we can go back to a 2 to 3% normalized annual rate.
I can see where if you have a theory that like there are some serious geopolitical risks that will metastasize in the coming months, which, that's not completely crazy. Yeah. Between energy in Europe or semiconductors in Taiwan, or, take your pick of the pleasantness around the world. But, if you really think that, I could see where that could all put a wrench in everybody's best laid plans. But,
and I suppose somewhat ironically, a lot of people cite the Biden administration's fiscal largesse as being inflationary. I haven't really seen them spend much money at all. They passed the bill or the bipartisan infrastructure bill, but that's going to be spent. The first checks aren't going to be written for another year or so.
Yeah, I think that. Well, I do think the two COVID fiscal packages from December of 2020 and then
December 2020, right?
21. Yeah, I think those combined, that was a lot of money.
That was a lot of money.
Just a lot of sugar to pour into the economy. I mean, that was the source of, Larry Summers' view on predicting, a greater inflation hit during the year than was expected. So I do think there's something to that. I'm less worried about the handoff, though. Is there going to be some fiscal drag? Yeah, it's going to be some fiscal drag, but I feel like there's handoff to the real parts of the economy. I mean, like the 150,000 new jobs in leisure and hospitality is a real thing, and I think you're going to see a lot more of that. These places are going to open up as Omicron goes away, and Omicron general COVID fears go away, and you're going to see a lot more of that in that space. And by the way, that is fantastic for inflation also, even if you see some price increases on the service side, if we see a transfer of discretionary dollar spending from the goods side of the economy to the services side of the economy, that relieves some of the pressure on supply chains also. So I think
but that's a really good point.
Normalizing the economy is a pretty good thing.
Because usually when we go in a recession, the rebound is slow. So, you didn't have a job, and then it takes a while to get it. This time we just shut down the economy. We paid everyone to stay home. Now that, knock on wood, we're behind it. If you want to get a job, you can get a job and replace immediately all that. This is the fastest.
Yeah, this was the fastest recovery on long-term unemployment in history of record keeping.
Yeah,
right. It went from over 4 million long-term unemployed to about 1.6 million long-term unemployed today in a very short period of time, in a year. That is amazing, right? Like that's, by the way, this is what everybody was expecting, right? We said like, look, as Omicron tails off and get better, we get vaccines, the economy is going to come back, and people are not going to be on this, what we've seen in the last few recessions, going back to 1990, recessions have, the reduction in long-term unemployed has taken longer and longer to work down those lists. So this is a really good sign overall for the economy, but this is kind of what we were saying, back in early 2021 with the CARES Acts and other things, was just like, we want to be able to be prepared for that quick rebound. And I don't think we should be so surprised that we're actually seeing it now.
Good point. Yeah.
Hey, let's take a break and come back, because I want to talk about earnings. I think this entire show would have been about like one of the most exciting earnings seasons if we didn't have an exciting jobs report. We'll be back on the Macrocast.
HPS is hiring full-time public affairs associates and analysts. We're seeking entry-level associates and analysts to join our dynamic team. Associates have immediate client exposure and opportunities for professional development while working in a fun, fast-paced, and challenging environment. Recent graduates or applicants with up to 3 years of postgraduate work experience are encouraged to apply. Learn more and apply today at hamiltonplacestrategies.com/careers.
All right, back on the Macrocast. Guys, I don't know. I was getting like pretty sleepy eyed during earnings seasons until this one. Like last few weeks have been really crazy.
Especially this week with the big tech boys reported this week.
Especially this week. Brendan, you want to talk a little bit about that, about what we saw on some of these?
Yeah. So this was actually a very interesting dynamic, and it kind of had a little less to do with the economy and a little more to do with policy. So Apple made a change to their, privacy policy where you can ask to not be tracked. Mm-hmm. So if you're, linked with this new policy, like Google is, so Apple really crushed earnings, Google crushed earnings. Today, Amazon, or last night, Amazon reported and crushed earnings, stocks up 12%. But the day before, Facebook reported and was down 25%, lost over $200 billion in market cap. And a huge reason why they missed was their ad revenue really fell off a cliff because, their algos are very much dependent upon being tracked so that they can very much target you to smaller businesses, where Google, does a little better in terms of large businesses. So it was a fascinating dynamic in terms of how, an individual policy seeps through to affect individual companies.
Yeah, we got lots of divergent. We got so many divergent. It just seemed like every day there was something different. Google was great. Facebook was horrible. Snap was incredible. PayPal was just disaster.
Yeah.
This follows, Netflix. We that was early in earnings season. It's easy to forget that was an absolute faceplant. Yeah. And so this is, but it is masking the overall trend. Tech has had a lousy year. Yeah. And even real,
but you have to keep it in perspective. It had an absolute ridiculous 2 years,
Yeah. Oh yeah, absolutely. They're all coming off like massive record highs and stuff. Mm-hmm. But this is the kind of, we've been talking about how the Fed and policymakers are orienting themselves toward the markets here and looking at it. This is, you still as a policymaker want to see, big high. It doesn't hurt you, it doesn't worry you to see big like inflated high flyers coming down, the Cathie Woods arc and that sort of thing. It's almost, more concerning if they were to keep going up. You'd be more worried about a bubble. So in the kind of environment we've got, the Fed put is way below us right now. Markets have been choppy.
Actually, that's kind of interesting. I saw the data the other day if you look at Berkshire Hathaway stock and the ARK stock, on a 2-year basis, they basically have the same performance.
Tortoise and the hare.
One massively underperformed and now is doing well, and one massively outperformed and now has come down to it. So I guess it is indicative of a diversified portfolio. It makes a little bit of sense.
Yeah, earnings season provides this interlude of micro, but the macro headwinds have really been, we think will probably become dominant after earnings season peters out. We still have some household names next week: Pfizer, Chipotle, Disney, Peloton. Twitter, although Peloton gave us a sneak preview, Coca-Cola, Pepsi, Win. And Expedia. These are definitely interesting. But a lot of the big message has been taken from earnings season, and on the other side of it, typically the macro drivers will come back into fore. And right now it's a challenging macro picture.
Yeah, we've never look. I mean, it's not unusual during an earnings week to see a company with a really big move. It's just completely unusual to see so many companies with really big moves. 20%, moves in their share prices. Those are massive, massive moves. And but I do think it's reflecting, broadly speaking, like step back right from the idiosyncrasies from each of those companies. I think what you described is important. Like what happened with Amazon, with Apple's, third-party rule, and like it definitely has an impact. And Facebook cited it, but there is this, we're going to see a shift a little bit. People are going to spend less time on their screens if we're moving back into something more, more normalized economy. And it doesn't matter whether that's Netflix or Facebook. if you're going to be in front of your screen or even entertaining yourself on your mobile device a little bit less than you were before. So some sort of normalization there, does seem to make sense. I have to say though, even just looking at the reporting though, yeah, there are companies I forgot that. I tend to forget that Pinterest even exists.
Yeah,
right? Right, like Pinterest was crushing it. It's like
I'm not really sure what it is.
Yeah, it's like Pinterest is still there. And same thing with Snap. Like I forgot. Like I thought it was all. I thought we're all TikTok these days.
That's up 50%, 52%.
Snap is. I think Snap is like. What are they up, Brendan? Like huge.
52%.
Yeah. It's like wow.
Well,
it's like
one of the things that you
the
can
closet
say
and find Snap.
About this dynamic, obviously, these tech stocks, as we said, have had a big run up. But with volatility like this, like Facebook is a really widely owned. It's a hedge funds are in it. It's a big stock. It's down like 30%. There were after the global financial crisis for years and years, when you saw big moves like this, and you saw big popular stocks like and the Cathie Wood Ark and Alibaba and like going down 50%, you'd be bracing for this like almost systemic level disaster at hedge funds and banks, at prop trade.
Good point. Yeah.
This idea that like equity market volatility would have all these bodies floating to the surface. It would have spillover effects into major spillover effects into other asset classes. The fact that the markets are absorbing this kind of volatility without completely falling out of bed, without it becoming a daisy chain into the a huge treasury market move or something like that. I think that's certainly a silver lining in some of these. And as a policymaker sitting at the Treasury Department, you want to see your financial markets be able to take a punch and have two-way risk, because that keeps people honest. And this is the kind of thing that right now I'm sure that they're looking at and feeling pretty good about. They also love the volatility in crypto. I mean, policymakers in the U.S. are definitely cheering for a great filter to be applied, the market to impose its culling of this and to get some of the bad actors and weak hands out of this market.
Well, crypto, while on the way up, is not so widely held that's going to be that a second winter is going to be super messy. I mean, like that, there's the difference between short term and long term.
Twitter crypto. It is held by everybody, and it's going to be a major effect in the midterm election.
It all depends on your reference point, right?
Yeah, but I mean, they might be right. Think Brady retired to get into crypto, so the world might look a lot different. He was good at his old job.
I think John's point. About I think the resilience of the of the markets. I think you're right. The guys at 1500 Pennsylvania Avenue should be pretty happy about seeing the market being able to absorb lots of big swings. Liquidity's been really terrific. The markets have performed very, very well in a very dynamic environment. On the crypto thing, right? I mean, there's nothing wrong. Like, invest in whatever you want to invest in. As most things, like the thing that leads to stumbling in the broader economy usually isn't the real asset or the unreal asset, as the case may be, with whether it's NFTs or crypto or whatever, but leverage to get to that asset. So
exactly.
You learn some things about, like, if people are levering themselves in order to invest in those markets, and then there are big shifts. That's where trouble comes in, and we'll learn.
Well, the best crypto story I heard was Odell Beckham Jr. Chose to be paid by the Los Angeles Rams in Bitcoin. So now that his Bitcoin is worth half of what it used to be, but he also has to. The correction happened in 2022, not 2021. So he's being taxed on it at the highs, and he moved to California and Los Angeles, so he's paying a 60% tax rate. So of the $1 million or so that he was paid, he basically is holding $78,000. He played for $78,000 this year.
Best bargain in sports. Yeah. Although I guess there's no savings to the Rams. I mean, the Rams
had to pay it. Odell,
technically speaking, they paid in dollars.
Exactly.
And then bought Bitcoin. Yeah. In the same way that my mayor here in New York City is doing the same thing. Guys, what a fun show. We had like so much so much great news this week. And
we didn't even talk about the war in Ukraine.
Hopefully, we'll never have to talk about the war
Exactly.
in Ukraine. But if something happens, we'll definitely get to it next week. Have a great weekend. Thanks for joining us on the Macrocast.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share.